Hi everyone. The Strait of Hormuz is a ghost lane. Where once 30 to 35 tankers passed daily, hauling the lifeblood of the global economy, now only 2 or 3 move through the war zone. The U.S. submarine has sunk an Iranian warship off the coast of Sri Lanka. The supreme leader of Iran is dead. And for the last 12 days, the world has been holding its breath, watching to see if this conflict, which has already closed the most important energy corridor on the planet, will tip the global financial system into a new era. In times like these, we look to the old standards. We look to gold. We look to silver. But here's the thing that the financial media is missing. The old rules no longer apply. The playbook that investors have used for the last 40 years has been thrown out the window. We are witnessing a structural shift in the monetary system. And if you are not paying attention to what is happening in the gold and silver markets right now, you are looking at the wrong war. Today we are going to cut through the noise. We are going to look at the fresh data from March 2026. Analyze why the precious metals market is breaking all the historical correlations, and map out exactly where we could be heading next. Let's start with the numbers that matter right now, this very minute. If you pulled up a chart this morning, you would see gold consolidating near $5,190 an ounce. That is a breathtaking number on its own. But to understand the volatility we are dealing with, you have to look back just a few weeks. In late January, gold hit an intraday high of $5,595. That was a record. It felt like the sky was the limit. And then, just days later, we saw the Black Friday event in the silver market, where prices plunged 31% in a single session. Now, if you were a casual observer, you might look at that crash and think the bull market is over. You would be wrong. Because right now, as the conflict enters its most dangerous phase, silver is trading in a volatile range between $82 and $95. It is recovering, it is consolidating, and it is setting up for the next move. But the price action is only the surface. The real story is happening beneath the waves, in the data that tells us what institutions and central banks are actually doing with their money. Here is the headline that should shock you. Gold is rallying even as the 10-year Treasury yield rises to 4.10%. If you have been investing for any length of time, you know that this is not supposed to happen. The textbook says that gold has no yield, so when bonds offer higher interest rates, capital should flow out of gold and into Treasuries. That is the correlation that has held for decades. It is broken. Completely and totally broken. Why? Because we are no longer dealing with a simple inflation hedge scenario. We are dealing with counterparty risk on a scale that the Western world has not contemplated since the collapse of the Bretton Woods system. When you buy a U.S. Treasury bond, you are making a bet on the full faith and credit of the United States government. But when geopolitical stability evaporates, when the U.S. is engaged in open conflict with a nuclear-capable adversary, when the Strait of Hormuz is closed, when energy supplies are choked off, investors start to question what full faith and credit really means. They are not selling gold to buy bonds, they are selling bonds to buy gold. They are fleeing paper assets with counterparty risk and seeking refuge in the one asset that has no counterparty at all: physical gold. This is the massive decoupling we are witnessing in real time. The old rules are dead, and the institutions are only just beginning to price this in. Let's talk about the elephant in the room, the Strait of Hormuz. Iranian media has been explicit. They will open fire on any vessel attempting to transit the strait. This is not a bluff. This is a wartime policy. And it means that roughly 20% of the world's oil supply is effectively offline. Giovanni Staunovo, a strategist at UBS, laid it out in chilling detail earlier this week. He noted that tanker loadings are continuing for now, but the problem is shifting to storage. Iraq has already been forced to cut a significant portion of its production because storage capacity is maxed out. Kuwait is showing signs of the same. The longer the straits remain closed, the more production will be cut. Now, what does this have to do with gold and silver? Everything. Because when energy prices spike, inflation follows. And when inflation follows, central banks face an impossible choice. Do they raise rates to fight inflation and risk crashing an already fragile economy? Or do they hold steady and let inflation run? The market's bet is that they hold steady, or even cut. The nomination of Kevin Warsh as the next Federal Reserve Chair has solidified expectations that rates will remain on hold through 2026, and that is a green light for precious metals. But here is where the silver story gets even more interesting, and frankly, more complex. Silver has developed a split personality. On one hand, it is a monetary metal. It benefits from all the same safe haven flows as gold. When the S&P 500 drops more than 5%, gold has historically returned an average of 2%. Silver tracks that monetary demand, but with higher volatility. On the other hand, silver is an industrial metal. More than 60% of annual silver consumption is tied to electronics, solar panels, and semiconductors. It is in your iPhone. It is in the solar panels on your neighbor's roof. It is in the data centers powering the artificial intelligence revolution. This is why the Black Friday crash was so deceptive. The leveraged players got blown out. The speculative froth was wiped away. But underneath that volatility, the physical market is tighter than it has been in decades. We are now in the 6th consecutive year of structural deficit for silver. That means we are consuming more silver than we are mining, year after year. The above-ground stocks that used to buffer the market are dwindling, and according to the latest data, inventories on the Shanghai Futures Exchange are near decade-low levels. China matters here. China accounts for 50 to 60% of global silver refining, and right now, all eyes are on the National People's Congress, which is meeting through March 11. The economic growth targets and stimulus plans that emerge from Beijing will dictate the trajectory of industrial demand for the rest of the year. If China stimulates, silver flies. But the most important shift in the precious metals market is not happening on the Shanghai Futures Exchange. It is happening in the vaults of central banks. The World Gold Council data is unmistakable. Central banks have nearly doubled their gold purchases over the last decade. They are diversifying away from the US dollar. They are diversifying away from fiat currencies entirely. Last year, for the first time in 30 years, gold overtook US Treasuries as the largest share of global reserves. Think about that. The dollar has been the world's reserve currency since 1944, and now central banks are signaling that they want something else, something that cannot be printed, something that cannot be sanctioned. A 2025 survey showed that 95% of central banks expect global gold reserves to rise in 2026. That is up from 81% in 2024 and just 52% in 2021. The trend is accelerating, and economies like China and Brazil still hold less than 10% of their reserves in gold. The runway for central bank buying is massive. But it is not just central banks. There is a new buyer entering the market, and it comes from a place you might not expect. Tether, the world's largest stablecoin issuer, has accumulated roughly 140 tons of gold. That makes them the 33rd largest gold holder in the world. They are sitting alongside nations. Stablecoins have grown from $28 billion in 2020 to over $280 billion in 2025. Predictions for future growth range as high as $4 trillion by 2030. And if these digital currency issuers continue to back their tokens with hard assets, the demand for gold could explode in ways we have never seen. This is a completely new demand channel. It did not exist 5 years ago, and it is one of the reasons why BlackRock recently stated that the bull market in gold and silver is far from over. So where do we go from here? Let's look at the forecasts from the institutions that move markets. JPMorgan is calling for gold to hit $6,300 by the end of 2026. But listen carefully to their language. They say there is a path to $8,000 if the structural factors align. They point to central bank demand, rising deficits, and the risk of a deteriorating economic backdrop if high oil prices persist. BMO is even more aggressive, with a $6,500 target. UBS is looking for $6,200 by June. BNP Paribas recently raised its forecast by 27% to $5,620, with a peak above $6,250 by year-end. These are not fly-by-night newsletter writers. These are the global, systemic banks. They are telling you that $5,000 gold is not the peak, it is the new floor. But let's be balanced for a moment. There are risks. There are always risks. The Commitment of Traders report released just yesterday shows that large speculators are hesitant. Net long exposure in gold has remained range-bound for 4 weeks. Traders are waiting for a pullback that refuses to materialize. They do not want to be seen chasing prices higher. If the conflict de-escalates suddenly, if the rumored peace talks gain traction, if a ceasefire is announced, we could see a sharp correction. The geopolitical premium that has been built into prices could unwind quickly. Naveen Mathur at Anand Rathi points out that the safe haven play is not as straightforward as it seems. Investors are also flocking to the US dollar, the yen, and the Swiss franc. The dollar index has risen 1.36% in the last month, and a stronger dollar typically pressures gold by making it more expensive for overseas buyers. So there is a tug of war happening. Geopolitical fear pulling one way, dollar strength pulling the other. But here is the key takeaway from all the data we have reviewed today. Kainat Chainwala at Kotak Securities put it succinctly. The degree of geopolitical risk is unknown. The market has priced in a disruption. It has not priced in a prolonged war that runs 4, 5, 6 weeks or more. That scenario is still not in the numbers. And that is the opportunity. If this conflict widens, if the Strait of Hormuz remains closed, if production cuts spread from Iraq to Saudi Arabia, then the inflation shock will combine with the safe haven shock. Gold could test $6,000 in a matter of weeks, not months. Silver, given its industrial sensitivity to economic disruption, could be even more volatile. But remember the deficit. Remember the inventory lows. Every time silver dips, the physical buyers step in. The floor is higher than the chartists think. The investment approach recommended by Tata Asset Management and echoed by BlackRock is worth considering. They suggest a staggered accumulation strategy. Do not bet the farm on a single entry point. The volatility is too high. The geopolitical situation is too fluid. But use the dips. Use the corrections. Because the long-term trend is clear. We're living through a regime change. The post-Cold War order, where the dollar reigned supreme and geopolitical risk was something that happened to other people, is over. We have a war in the Middle East that has closed the Strait of Hormuz. We have a Federal Reserve navigating the impossible triangle of inflation, growth, and debt. We have central banks buying gold at a pace not seen since the 1970s. We have AI and electrification driving industrial demand for silver into structural deficit. We have stablecoin issuers accumulating physical bullion. And we have a price chart that just broke above $5,000 and refused to look back. The old rules are dead. The old correlations are broken. And in this new world, gold and silver are not just hedges. They are the only game in town. As always, do your own due diligence. The markets are volatile, and nothing we discuss today constitutes financial advice. But the data is the data, and right now, the data is screaming that something historic is unfolding. Thank you for watching. We will continue to track this situation closely, and we will be back with updates as the conflict evolves and the markets react. Until then, stay safe, and pay attention to what the central banks are doing, not what they are saying. If central banks, stablecoin issuers, and institutional investors are all quietly accumulating physical gold and silver at a pace we haven't seen in decades, while the old correlation with interest rates lies shattered and the Strait of Hormuz sits closed, the question you have to ask yourself is simple. Are you still waiting for a pullback that may never come, or are you finally willing to accept that the game has changed entirely?